Welcome to our program. To my left is John Grand, who's one of the country's leading upstream oil and gas M&A lawyers, and a great guy to boot. While ABS securitization transactions are financings, as many of the folks on the line know, oil and gas assets are particularly complicated. And a lot of the more interesting issues, more complicated issues that arise in the course of these transactions are M&A type questions. And John's been essential in helping us think through these. To my right is Svi Wurzberger. He's a partner in V&E's finance practice. Svi does a number of different types of financings, often very bespoke and very complicated. And he's been integral in these transactions in structuring the hedging arrangements, as we'll see, which we'll see are extraordinarily important. To my left, also to my left, is Niels Jensen. Niels is also a partner in the finance group here. He's a relatively new addition hailing from Millbank. While we're trying to convert him into an energy lawyer, his true expertise is aircraft financings. But as luck would have it, he's also a securitization expert. And we've really enjoyed his thinking and helping us think through these new novel oil and gas ABS structures. Finally, my name is Dave Wickland. I'm a partner in our finance group. I've done a number of the securitizations at the firm. I also spend a significant portion of my time representing the firm's private equity clients and corporate borrowers in connection with acquisition and other leveraged financings. So with those introductions, I'll let John describe what's going on in the oil and gas space with respect to securitizations.
Thank you, and welcome everyone. And hopefully we'll have an informative and interesting presentation today on upstream securitizations. So what has been happening? What is going on in the industry? This slide indicates just the publicly announced transactions. It does not get into a whole host of private transactions that we and others have been a part of. But as you can see, dating back to late 2019, when the first securitization was done by Ryza Energy, and they raised that first case, it has really exploded in terms of the number of people that have looked at it. Guggenheim was originally the first bank that was sort of out trying to put this product together and bring investors together. They spent a lot of time thinking about it, trying to get it organized. And in 2019, they partnered with Ryza Energy, which was a non-op working interest owner, and they closed on the very first securitization. Then obviously 2020 hit and things went slow. Diversified got out and had been working on one that they had gotten done. Diversified has now done 5 publicly announced securitizations. Ryza has done 2. They closed a second one earlier this year. Presidio, as you'll see, has done 1, and then Pure West Energy has done 2, and the Pure West are slightly different. The first group have been private placements, what we call 4A2 investors. We'll talk about that in a little bit. The Pure West has been a 144A/42A investor, meaning they've done a broader marketing and broader solicitation and sale of the product and have started doing larger deals. But in all, I think when I've totaled these deals, especially in the last 2 years where it's really picked up steam, there have been $2-3 billion or more of this product that have been placed with companies. And we as a firm right now probably have another $2 billion plus in transactions that we are actively working on with clients that are trying to get deals placed. So it's a very active market and product, and there's a lot of money sort of going into that and people looking at the financings. So I guess the question then, David, is why are people looking at these securitizations compared to other financing, and how do they differ as you're thinking about it?
That's a great question. These are the ABS oil and gas securitizations are highly structured and very, very challenging deals. But I think the reason they've attracted a lot of interest are twofold. First, the transaction prevents a means or a way for corporate borrowers essentially to term out their RBL facility. As many of you are very well aware, we just went through sort of a period of extreme volatility in the oil and gas space, and many commercial banks who are the traditional providers of reserve-based facilities, essentially made an internal decision to reduce their exposure to the oil and gas space. One of the ways this manifested itself was many corporate borrowers had their borrowing bases cut. Borrowing bases is what the banks lend against, and a smaller borrowing base means less liquidity. And it can, for an over-levered company that gets its borrowing base cut, it can cause a big problem. So one of the things that the ABS transaction offers is it's a means of obtaining relatively cheap investment grade capital at a fairly high advance rate. So the cost of these products between about 4.5% and 7%, give or take, it's a fixed rate, is very comparable to say an RBL. And the advance rate, somewhere between 55 and 75% of PV10 compares very favorably, to the RBL market. One of the reasons, issuers are able to get such a good rate on this paper is that there's all sorts of bells and whistles included, as we'll get into, that basically ensure the structural integrity of the product. But from an issuer's perspective, one of the real big benefits is that there's no borrowing base, so there's nothing for the banks to take away. So as we saw, a number of corporate borrowers had to file bankruptcies because the banks basically cut their borrowing bases, severely. That's not really a risk in ABS land, because once you've got the money, you've got the money. The other nice feature of the ABS structure relative to, say, an RBL is that the ABS structure has very limited true financial covenants. The financial covenant that we've seen in a number of the ones that have appeared has been an interest-only debt service coverage ratio, which is effectively, in its simplest form, cash over interest expense. And the ratio is set at 1.05 to 1. And what that basically means is, as long as the issuer is able to make its interest payments, it's not going to default that covenant. Compare that to an RBL, which has a maximum total leverage ratio of 3.5 times. As we saw in the most recent downturn, many corporate borrowers blew that covenant, when their EBITDA declined, sort of concomitantly with a decrease in commodity prices.
And you pointed out, I think it's good that a lot of people are using this either as a tool for recapitalization and a distribution of cash to investors, or they're using it as a way to term out their RBL. But for those that aren't as familiar with the borrowing base, in the downturn, if your company had $1 billion borrowing base on your RBL, the lenders would get to reevaluate that twice a year, and they could just decide that the borrowing base is now $500 million. And if you had $1 billion borrowed and outstanding, you had 6 months then to repay the $500 million, which became a big problem for companies and resulted in bankruptcies and tighter liquidity, not being able to operate. The other difference with the RBL is you're just paying interest back on that borrowing. There's not like an obligation to amortize the debt and pay it down over time. Whereas with the ABS, you sort of get the benefit of lighter covenants, because there's a soft amortization schedule that over a 7.5-year period or 8-year period, whatever you've termed out, you're going to be paying back some principal and some interest on that facility. But it's not a fixed amortization schedule like your house, that if you miss a payment, they're going to foreclose on you. If you miss the payment or there's an issue with cash flow, the schedule itself will re-amortize, and it'll extend out over a longer period of time to repay the.
And that's an important point, because compare that to, say, a high yield bond that doesn't amortize. I mean, the idea behind the ABS transaction is that you're going to pay the thing off from cash from the oil and gas assets over a period of about 7 or 8 years, and that's why you're able to obtain an investment grade rating on the product and a relatively good yield. Just one other point, that the other reason people are thinking a lot about these is, as the M&A market for these assets over the last several years has been up and down. And if you think about it, and John will get into this in the next slide, but these structures really provide what you can think of as a partial exit, in that a sponsor or a parent company transfers assets to an SPV basically in exchange for a large cash payment that it can return to its shareholders. So you can sort of think of that as a partial asset, and the ABS has a sort of additional advantage, is that if the product is performing, it will continually return cash over time, which can likewise be distributed to the shareholders.
And on that M&A point, just to touch base, so much of the last 10 or 15 years has been on the shale drilling and new developments and the PUD locations and what's the upside and how to drill. And what's often gotten forgotten in some of those deals is the more conventional wells or the longer life producing assets of the PDP. And people have always sort of looked at that at a PV10 valuation, and that's what I report in my books. But what we've started seeing since 2018, 2019 is when you actually try to sell those PDP assets and less drilling or no drilling, but just the field has been developed and it's producing, you're not really going to the market getting a PV10 valuation to sell the assets. It's something higher, PV15, PV20, depending on where you are. Some of these basins may not be the sexiest basins that everybody wants to be in right now. And so the demand from buyers paying a premium for those assets has gotten low. And so, when a company is looking at conventional assets, what you're really looking for in securitization is stable cash flowing assets. And really what's happening in this securitization is we're trying to come up with the most stable cash flowing revenue stream we can, and then securitizing that in a bankruptcy remote entity where those cash flows can be sold to insurance companies and other investment grade investors that want exposure to energy but want it at an investment grade level that Fitch and someone else can rate. And so it's just an asset class that maybe hadn't been at the forefront of M&A when you're looking at those types of assets that are now looking at this attractive financing or refinancing in some of these cases for the transactions.
So the next slide lays out some of the pros and cons of these transactions. And I think we've frankly hit on a number of the pros already, in that you can get a low yield, pretty good advance rate. It provides an ability to monetize assets that may be difficult to sell in a down M&A market. But if you're doing one of these, there's a lot of considerations to think about as well. As John just alluded to, this structure is not suitable for every sort of asset base. Traditionally, when you think of a securitization, you think of assets that are, you think of like home mortgages or credit card receivables, assets that produce cash where you don't have to do a lot of work. Oil and gas assets are obviously completely different and much, much more complicated. The first observation being that money doesn't just come out of the ground. You've got to get the oil out of the ground or the gas out of the ground and then convert it to money. There's a variety of different basins, types of wells. They may have different, decline curves. They may have different levels of engineering risk. But as John alluded to, in order to make this work, you've really got to have assets that are stable and produce consistent cash flow. So I think a lot of the companies that have done these transactions have had mature assets that have produced oil and gas forever, that have pretty low engineering risk. The second thing to note here is that obviously commodity prices are extraordinarily volatile, as we all know. So you have to deal with this risk, and the way to deal with it is obviously through commodity hedges. But these aren't simple commodity hedges. The expected time for repayment of these facilities is 7 or 8 years. And that means in order to make this work from a securitization perspective, the volumes have to be hedged for a significant portion of that time. And putting those hedges in places can be a little cumbersome, and there's a number of hedge counterparties you have to deal with. Which brings me to my next point. These are not simple transactions, as we've all discovered. I mean, they're very much financing transactions wrapped up with M&A transactions. And when you're doing these, as John alluded to, the 4A2 investors are insurance companies. Insurance companies are often very difficult to deal with. They're very careful. They like to read every document, negotiate every document. Likewise, because hedge counterparties are putting in place, call it 5-year hedges or more, the hedge counterparties will read all the documents. They'll try to negotiate all the documents. So you've got investors negotiating, hedge counterparties negotiating, then you've got an indenture trustee. You may be doing a 144A deal, so you've got a placement agent. But the takeaway is that doing these transactions is very complicated because you're dealing with a lot of parties and they're all going to have something to say about the documents. So it's not like putting in place an RBL, which you can do in 2 weeks, or putting in place a high yield bond, which you can do in a month. These are 2 to 3 month transactions. As a consequence, not great for acquisition financings. There's ways to do them for acquisition financings, but not great. But these are some of the things that you need to think about if you're considering doing one of these. And I'll let John now discuss how the transactions are actually structured.
Yeah. So as David mentioned, these are more akin to highly structured financings than typical regular way credit facilities. And here is sort of a structure chart of what a deal looks like. But you can really just take a step back, and if you look at it, you'll say, this is the kind of crap happens when I let lawyers just run amok on a deal. And that's the structure. So on this chart, the blue triangle, think of that as the operating company, the group that exists today that has the assets. It will start by forming the 2 pink entities, which is a holding company and ABS issuer. And these are set up to be bankruptcy remote companies, meaning that if the sponsor files for bankruptcy, the 2 pink companies can't get dragged down into that bankruptcy. And that's very legal nuanced. We put in provisions and work with it, but lots of transactions have that structure. So that's a relatively easy part to set up. Then when the transaction closes, what happens is these are all wellbore deals. So there's there's a purchase agreement or a conveyance document with a wellbore assignment where the wellbores are moved from the sponsor down into the ABS issuer, the company that's going to issue the notes and the securitization. Those assets will drop down. That ABS issuer will, in exchange, take the assets and then sign an indenture and issue these secured notes, debt instruments out to various note holders for cash. And the issuer will use that cash and kick it back up to the sponsor, along with the equity in the holding company, so that when the dust settles, the sponsor has money and then owns these 2 entities 100% underneath its structure. The note holders off to the right will have secured debt instruments in the ABS issuer with guarantees and equities and pledges. And then because you're dealing with oil and gas assets, in some cases, all the assets move down. In some cases, it's a partial interest in wellbores that are moving down, but there will be sort of normal course arrangements between the ABS issuer and the sponsor to manage and govern the operation of those wellbores during the term of the notes. And that's typically done through a joint operating agreement and a management services agreement. But those are not your typical JOAs and MSAs. They are highly negotiated documents with a lot of protections for the note holders to make sure that the wellbores and what is really being conveyed and what's being contributed is just straight cash. So the purchase agreement, the MSA, the JOA, these are not normal M&A documents. These are financing documents. And when you think about it, similar to a credit agreement or a cash flow stream, they are designed and set up so that the note holders, all they want is to give you money and then get that money back with a small return at the end of the day. And they're making that loan secured really just in the cash flow from these assets. So they want to know that cash flow from the assets is unencumbered, doesn't have liabilities and problems and things that would impact their ability just to receive the cash flow. So the sponsor will make indemnities and provide protections for sort of anything out of the ordinary that exists at the time you're dropping these assets in to make sure that what's going in as a clean asset, and that clean asset is what's being securitized in the transaction. But the sponsor, if the assets don't perform, there's just not enough cash flow from the assets to repay the notes. It's important to note the sponsor is not on the hook. They're not providing a guarantee. They don't have to repay the notes off of their balance sheet. But if the assets perform and there's just not enough cash because prices drop and we can't repay the notes, the note holders are limited to the pledged equity or the assets and the wellbores that have been assigned down to the issuer. They can't go back up after the sponsor for shortfalls in payments. As David mentioned in the notion of how structured these are, this slide just shows all the different counterparties that you're going to have to deal with, and everybody that has counsel, if you're on the issuer side, looking at these. But you're dealing with a placement agent, one of the commercial banks that are in the space doing this. You're dealing with the sponsor and the entities that you set up, most likely needing local counsel in addition to sort of field counsel. The ratings agency, the hedge counterparties, there's an indenture trustee that you've got to work through and their counsel. There is usually a backup manager. This is the person that steps in if the assets are not performing and you're foreclosing. Then the investors don't want the sponsor to be running things and they want someone else to step in. That's the backup. That's usually like a restructuring advisor that will take that role. And then you've got all the different investors that are looking at it, and they may have their own counsel or multiple counsels looking at and reviewing documents and providing it. In terms of timing, I won't go through all of this, but it's not a quick transaction. I think most of the banks are advising clients this is a 12-week process, and some go longer than that, and some go slightly quicker than that. But for first-time issuers, you should really count on 3+ months from when you get going fast to when you're going to get closing. And part of that is you've got to go through an entire ratings agency process and provide information while negotiating documents to get the rating that you're going to have. And then once you get the rating, you then need to go do marketing and bring in investors and negotiate with them. So it's just a lot of parties and it takes time to do it. And this is a process where you are trying to time the market and put your hedges in place, because once you lock the hedges in, you've locked price in. And so it's a tough process to get started and try to get done so that you've got those hedges and you don't want to miss the market. And there have been deals that have gotten all the way up to week 12 and about to place the hedges, and then prices move against them and they've got to put the whole deal on hold until prices rebound and they could go time the market a little better on that. So hedging agreements, Fee, you want to talk about what's done there?
Sure, John. So Dave was mentioning earlier that key feature for securitizations is that the underlying asset needs to have generally stable cash flows. As you mentioned, you have to have oil wells or gas wells that have relatively stable engineering so that you can fairly comfortably predict what volumes you're going to be producing over the term of the securitization. The counterparty that is fixing prices, which is the role of hedges. So generally, we will see hedges for both hydrocarbon pricing, oil, gas, NGLs, and also basis differential as far as transportation differentials and such. And those can vary a bit, but generally what we've seen is 80 to 85% of your projected production for the relevant period will be required to be hedged. In later years, once that initial period is run, sometimes you get step that down a little bit if your financial metrics meet certain thresholds, if the ABS has been paid down according to the expected amortization, everything else is otherwise healthy. But in general, that 80 to 85% is what we see for a good chunk of the underlying period. Oftentimes we see the initial hedges, especially for kind of basic hydrocarbon pricing, be 5 or 6 years. NGL is a bit less. Basis can vary. But again, the idea is from the note holder's perspective, they're looking at an asset that when you take the production of the oil and gas wells plus the locked-in pricing from the hedging, they have a general idea of what cash flows are going to come in to service the interest and the principal of the notes over, a good chunk of the initial lifetime of the notes, particularly the beginning where they have the most exposure and their risk is the highest. They want to make sure that period is pretty locked in as to how much cash is going to be coming in. As the initial hedges roll off, there's typically a requirement to maintain, I think what we've generally seen is a 2-year, 24-month kind of forward book on hedges. So kind of at the same level as your initial hedges roll off and you start hitting a period where you've only got 2 years left, then you'll start having to add additional hedges in the further months to maintain, kind of the fixed pricing for at least, a couple year period going forward as the facility continues to pay off. As far as counterparties, I think sponsors typically will initially start talking to their existing hedge counterparties who are doing their hedging, the regular production, often lenders in the RBL. They're also, see deals where, they get entities that are and hedge providers that are not in their current facilities who come in really just to do the ABS hedging. I think in the industry, I think banks are, more and more starting to get into ABS hedging, but for banks that have not done it before, it's, as Dave mentioned, a lot more complicated as far as documents. They're not just looking at a credit agreement, a hedge agreement, and an ISDA and intercreditor. They're looking at an indenture. They're looking at somewhat complex waterfall mechanics and where exactly they fit in. So it's a bit more of a complicated experience and requires a bit more learning from the bank side, especially ones who haven't done this before.
And so, Svi, it's been a relatively, in my experience, a smaller universe so far of banks that have been willing to hedge in this space. Is that right?
Yes, no, and we had a deal earlier this year where they were entertaining, I think originally 4 hedge providers, and 2 of them, and one was just really not, it was just more complicated than they wanted to get involved in the other one. Which I think we've seen since get into these deals was really kind of asking a lot of questions, learning, but ultimately not just on timing, just wasn't able to get there fast enough for the deal. So it's also another thing to keep in mind is if you're dealing with newer hedge counterparties or people who haven't done this before, you want to try and make sure you've got a couple of counterparties in place in case one of them falls down or just can't meet your timing, especially as was mentioned, you're trying to time the market. If you can't get your hedges in place in time because you're still negotiating over things that other hedge providers are more comfortable with and have gotten there already, you want to be able to pivot and just say, okay, we're just going to deal with these 2 hedge providers and we'll get you next time on, a bank that's still learning.
Can I ask you a question? What do you do if you put hedges in place and the deal doesn't close?
So that, we can get as far as when you put the hedges in place, which I think is the next bullet, right? So timing, you have, until the deal closes, the ABS is an empty shell, right? And that entity, the pink entities on the previous slide, those will not have any assets, will not have any ability to enter into hedges. So as far as entering to the hedges, if you're trying to get your pricing locked in prior to closing as necessary to be able to market, what you do is the sponsor will enter into hedges at the sponsor level, kind of together with its existing RBL, which occasionally will require an amendment, and either with their existing hedge counterparties or with the new potential ABS counterparty. But again, this is not a hedge at the ABS; it's just kind of your normal RBL level hedging. And then you'll novate at closing, and you'll novate those hedges down to the ABS with the asset. If ideally, you just kind of enter into the hedges, whatever new hedges you have, with the prospective parties. They may not be a member of your RBL syndicate, and then there's different, structures where either they come in unsecured, but just for a limited time. And if the securitization doesn't close, they will then, have a termination event on their hedge, in which case they'll either terminate or more likely you'll novate those hedges over to one of your syndicate banks, so you don't face termination event.
But this is sort of like almost like the biggest jigsaw puzzle, complicated piece of the transaction, and it's a huge chicken and egg deal because you have to have the hedges in place to finish your model, to know what the cash flow stream is and what you're going to market and what you're going to sell to investors. But you really don't want to enter into the hedges until you know the investors are there and the deal is going to close, because as David pointed out, if the deal doesn't close, you may be stuck striking all of these really big hedges. And then to add on the complication, not all banks are involved in doing this right now. So you may have existing hedges in place with banks that don't really want to be part of your ABS facility and aren't willing to novate those hedges down. So you've got to bring in other banks and move hedges around. And some of those banks may not be secured. So if they're putting hedges in place before the ABS exists, what happens to them and their credit and their support if they don't have mortgages on your assets because they're not in the bank facility. So it is a very complicated puzzle piece that to a large degree has to be thought out and put together by the investment bank. The placement agent is working on it, and that's why they get paid their fees and we get paid our fees on the deal, because this is what drives value so much in the transaction and figuring it out. And it has added a lot of stress on deals where we're on the verge of launching and about to close or trying to put hedges in place. But because of these issues that you're working through and so many different counterparties you work through, that you just can't get the documentation finalized. And it is not a fun conversation to have with a client where you are talking to them and they are saying, damn it, I got to strike these hedges right now. And you're saying we can't because we don't have the legal documentation, and it spills over to the next day and commodity prices go down. And people are saying, like, what legal issue was possibly out there that cost me this money? So, this is probably the most important issue to try to get ahead of very early on in the deal, figure out the jigsaw puzzle with how you're going to put these hedges in place, come up with a game plan, and then make sure that the hedge counterparties have done their diligence. You understand the risks of what happens if the deal doesn't close and when we're going to put them in place, and that you are ready to execute on this, because you just don't want to miss the mark here.
Yeah. And a lot further to John's point, a lot of the just kind of planning and table setting for that is making sure you get both your potential hedge counterparties and, frankly, to the extent you're going to need any sort of accommodation from your RBL lenders, whether it's to hedge more than the RBL covenants permit or to allow for securitization to secure hedges with non-syndicate members. You want to get that discussed early. You want your hedge counterparties to have a good sense of your ABS documents and be pretty comfortable that they're even if they're not fully done negotiating them, that they're pretty comfortable with where it's going, and you'll get there with them, and that your RBL syndicate will accommodate what needs accommodating and allowing time for banks to run their usual amendment processes and such if necessary. Because as John mentioned, it's unpleasant when you kind of get jammed at the end there, and it has real world consequences. It's not just a couple of late nights for the lawyers. That's baked in the cake. So
let's talk about the advance rate on these deals and what that really is of the value of your assets, what is getting advanced and how much are you able to borrow against the value of the assets. So if you think RBL, this is sort of the equivalent of what is your borrowing base to get to borrow against on the assets. What we are seeing is lenders and the ratings agencies are really focused on and allowing you to use a PV10 valuation for the assets when they're coming up with the advance rates. And they're basing it typically on the company's reserve report. We have seen more recently in a couple of deals where the investors have insisted on bringing in a third-party reserve engineer, not so much to do a separate independent audit, but someone to come in and just sort of kick the tires and look at the reserve report and generally make sure they don't see some major hole or problem with the reserves. But then based on the issuer's third-party audited reserve report as of the effective time for our transaction, we're generally seeing reserve or advance rates somewhere between 55 and 65% of the PV10. So if I've got $1 billion of PDP, PV10 assets, I can borrow, the loan would be somewhere between $550 and $650 million. And some deals have gone as high as 70% as they're working. And how much you can borrow is really a case of the sensitivities and the modeling, and figure out, what you get to the right ratings agency's number, and how steady and predictable those cash flows are. I don't think, to my knowledge, a mineral securitization has been done yet, but there has definitely been talk and people looking at it. I think the premiums of selling minerals still in the public market has a pretty high multiple, and so we're seeing more deals to publics than people holding it and refinancing it. But from what we've anecdotally been told, because there's no cash outlays, no expenditures on the mineral side, you're just bringing the cash in, that the advance rate, if we ever do one of those and the deal makes sense, would probably be closer to 70 to 75% of the value, the PV10 value of the assets.
Okay, one of the more critical features of the ABS product is the cash waterfall, and often people have a lot of questions about this. So we'll walk through it on a simplified level. So in the typical oil and gas securitization, amounts from oil and gas production will flow into a collection account, which is typically held by the indenture trustee. It's a they have a security interest in the account, and then on a regular payment date that occurs, at some point in each month, they'll call it the 10th calendar day of each month. The trustee will distribute the funds in the collection account in accordance with the order set forth in the waterfall. As the name waterfall suggests, amounts at the top of the waterfall are paid before amounts at the bottom of the waterfall. And as John...
And it's different than an RBL, right? Like in an RBL, the money is going to come into the company from the sale of the proceeds and the cash, and then it's sort of blocked, right? You can't distribute it out or take the money out to the issuer or to the parent.
Correct. I mean, one of the key features of the securitization structure is you can sort of think of it like a lockbox. Getting it's a little more complicated here. I mean, usually what happens is the cash goes into the sponsor's operating account. And it may have to pay that to third parties, but after a certain period of time, usually a few days, it has to move it, the ABS issuer's portion, to the collection account.
But in the RBL, like if I have excess cash at the end of the day, I got to use it to pay down my credit facility instead of taking it out to keep it to myself. Whereas here in the ABS structure, if the cash flows from the assets come in and we go through and we pay down each of these different buckets and tiers, that extra cash the issuer gets to keep. And that's I think a key difference in this versus other, high yield or RBL credit facilities, where the cash is going to be basically trapped within the system until the credit facility is repaid, subject to restricted payments and
flexibility
and some flexibility, right. Certain dividends. You got to pay down the facility. Whereas here, because you're paying down the facility over time, if the assets produce more than what you're required to sort of pay off and some reserves, the excess gets to come back to the issuer, which is a very nice feature.
Well, that's one of the reasons why you do these transactions, and you hopefully structure them with enough room where you're going to continually be getting distributions over time. And this goes back when we talked at the beginning of this presentation about partial exit. I mean, this is a way to return cash to shareholders, essentially. So yes, it is a critical feature of the product. But as I was saying, so amounts at the top of the waterfall are obviously paid before amounts at the bottom of the waterfall, and the trust or the issuer comes last. And that's at that point you can make distributions to shareholders. But the first two rungs of the waterfall are really administrative expenses, trustee fees, management fees, and these are capped. But one thing to note here is that there are also operating expenses that will need to be paid, but these are actually netted out of the collection, so they don't actually hit the waterfall. But that gets getting a little more complicated. Once these sort of administrative fees and expenses are paid, the next rung of the waterfall are note interest and regular course hedge payments, right? And there's always discussion where the hedges are going to come in the waterfall, but I think most hedge counterparties obviously want regular course hedge payments to be on a pari passu basis with note interest. And going down the waterfall, liquidity reserve account is sort of a technical type of thing that is just there to ensure that there's enough money to pay interest.
That's just a separate account with basically estimated 6 months worth of interest.
Right. So if for whatever reason there aren't available funds to pay interest in 1 month, there would be a withdrawal from the liquidity reserve account, and then if there is cash in a subsequent month, it would replenish the liquidity reserve account. But as I mentioned, because this is all out of available funds, not being able to do these things, not being able to refill the liquidity reserve account is not going to result in an event of default. The one exception, or maybe the two exceptions, are note interest. If you miss an interest payment, that will be an event of default. And if you miss a payment on a hedge, through a sort of a backdoor way, that could also be a default. But if other payments are missed, it does not cause an event of default under the ABS structure. Once you get past the liquidity reserve account, there you get the scheduled amortization. As John mentioned, it's a soft amortization. There are schedules attached to the indenture, but if the payments are missed, it is not an event of default. But this is one critical way, like the ABS differs from a high yield bond. The idea is that this thing is repaid over a period of 7 to 8 years, and if the product is performing, the issuer should be hitting the payments on its amort schedule. If the product isn't performing, the ABS is structured to go into what we colloquially we call, can't say that word right now, so I'm going to try. It goes into what we call turbo, which basically means that all of the cash of the issuer is swept, and the ABS goes
to
into
get you back on track. Yeah,
to get you back on track, and we'll get into this onto the next slide. But there are a handful of financial tests that determine whether or not the ABS is performing, and if these financial tests are missed, that's when cash flow is swept, and it's usually 100%. But there are deals where the percentage is lower. But from a CFO's perspective, it's critical to model, make sure there's enough room under these financial tests, because if the whole idea behind the ABS is to periodically take dividends out, you don't want to be in a situation where your ABS is sweeping all of your cash. That would be a terrible result. And then, there's a couple more technical rungs of the waterfall, but if the ABS is performing, the cash will flow down to the issuer, and the issuer will be able to distribute it out to its shareholders.
We made the issuer bucket the smallest. We should have hopefully been optimistic and made that bigger, of what's getting distributed.
Well, the amount of cash is always decreasing, right? It's decreasing over time. So one of the things we always get asked about by management teams, or what they're always curious about, is what financial covenants do these things include? And as I mentioned earlier in the presentation, there's many of these securitizations, I would say, include one true financial covenant in the form of an interest-only debt service coverage ratio. And I say this is a true financial covenant because it's tested quarterly, and if you miss it, it does result in an event of default under the indenture. The interest-only debt service coverage ratio is the ratio of securitized net cash flow, which is basically collections. You give effect to hedge payments, and you take out payments from the first two rungs of the waterfall over interest expense. And it's set at 1.05 to 1. So as long as you're able to make your interest payments and have a 5% cushion, you're not going to default that covenant. So it should be relatively easy to meet. These other tests listed on the slide, the loan to value ratio, the debt service coverage ratio, and the production tracking ratio, really determine when the loan goes into the turbo I was talking about on the previous slide. If the loan to value ratio is it's tested quarterly typically, if it's too high, if the debt service coverage ratio is too low, or if the reserve report is showing that the issuer should be producing this much production, but the actual production is less than whatever the threshold is. Those are sort of warning signals that the ABS is not performing, and when that happens, that's when cash starts to get swept. So missing these other three covenants has two effects. One, it puts the ABS into turbo, and second, it gives the backup manager, which is somebody who's, think of it like an administrator who looks at the structure and makes sure everything is going well, as a third party. It gives them additional rights to ask questions and come up with a traditional, like a transition plan to kick out the existing manager. And it basically gives them an audit right in a sense. Go to the next slide, John.
So what you see here is a list of the key documents. We won't go through all of them. We've talked about a number of them, but they're grouped, loosely speaking, into separate work streams. So there's the credit documents, the asset conveyance documents, hedging we've covered, but I'll pick out a couple. So the indenture is really where most of your ABS will be governed from closing onwards. So the waterfall David was speaking about, that's all covered in there. Covenants, financial covenants, that's all in the indenture. So that's really, if there's a question about anything that the ABS cannot do, it has to do over time. There's some sort of plumbing for securities law issues. That's all in the indenture. Then on the asset side, the transfer agreement, obviously, that's the M&A piece of it that we alluded to before. So that's a key document, and that'll tie into a couple other things, especially on the opinions later as well. And then the joint operating agreement, because the ABS issuer is a shell. It doesn't have any employees. It's not permitted to have any employees. It'll have a board. That's the extent of it. It really relies on the operator to do what it has to under the joint operating agreement to really make the deal perform and to make sure that the cash flow comes from the oil in the ground. Hedging, so we sort of elaborated, but it's obviously a key consideration of the structures. And then something that people may or may not appreciate, depending on familiarity with structured finance, is the governance agreement. So yes, these are simple companies that'll have their bylaws and the LLC agreements depending on the type of entity. But there are a number of things that have to go into those documents for banks of remoteness purposes, to make sure that we have all the bells and whistles in there, to make sure the entity will stand on its own, but also to satisfy ratings criteria, because these deals are rated. Every rating agency will have their criteria. Some are a little bit more rigid than others, but in the end, there are a number of features you have to include here. So it might be a bit more nuanced than from a regular facility, or a regular asset holding subsidiary you have, but nothing unheard of. And then on the legal opinions, there's a couple I'll point out. There's a non-consolidation opinion. John sort of alluded to this at the beginning. Really, what you need that to say is that if the sponsor, which is also going to be the operator in most cases, is falling into bankruptcy, that will not drag in your issuer. So you have a bankruptcy remote box, as it were. The true sale, it's obvious, but it does give you comfort that the sale is going to stand even if the seller goes into bankruptcy. There's no clawback risk.
The one thing I'll mention here is that a lot of the people online are probably used to seeing opinions in connection with RBLs and bonds. These are much, much more substantial opinions. They're all sorts of legal analysis. Some of them are at least 50 pages long. It's important to start on these early, because oil and gas assets are so complicated. There can be real issues that need to be thought through. So this is a big part of the process that clients don't necessarily see, but in the background, there's all sorts of very complicated analysis and thinking going on with respect to these opinions.
Yeah, these opinions are why CFOs don't like lawyers. With the length of them, and then going through the documents and people saying what you can do and you can't do. But again, when we approach these transactions, there are definite issues that can stop you in your track. And the key to me is to get this deal done on the timeline that we've talked, and not to miss our window of when prices are good, because issues come up late or there's problems. So what we as a firm try to do at the very outset of the deal is to go figure out what the red flag issues are, figure out the puzzle pieces for the hedges, figure out what's going to impact the opinions or any other documents, and really try to, like, in the first 2 weeks of talking about this, before you get too in depth, figure out the solutions to those problems and make sure everybody's in agreement so that you don't get problems. And I've heard too many horror stories in these deals where someone didn't appreciate how certain consents would be different than an M&A deal, or wellbore assignments can't work with federal leases, or whatever the issue is, that you get to the finish line and then all of a sudden an issue comes up, and it's ultimately solvable. But when you look at the number of documents and what the issue's got to flow through to get people comfortable, it can just delay things by 2 weeks, and that's what you really want to avoid.
Yeah, and I would add to that the local council opinions, because there will be, depending on the location of your assets, there will be a local council component that also might have a transfer aspect to it. So it's important to start this early, have the conversation with your local council, with your opinion bankruptcy experts at the outset to make sure the structure will work. And so far, you may remember the chart at the beginning about the publicly announced transactions. Most of them were in the 482 format. A couple were in the 144A format. There's obviously a couple of differences. I mean, the 482 is a less comprehensive from a labor perspective. Securities offering, you deal directly with the investors. The issue sells directly to the investors. There's no underwriter standing in the middle of it. The impetus is on the investors to ask questions, to ask for information, rather than there being an affirmative disclosure obligation. And so that has a couple of impacts on how the transaction is going to work. I mean, for one, the execution is a lot faster. I would estimate about 3-4 weeks at a minimum if you do a 482 offering versus a 144A. Involved with that is you will have low transaction costs, and largely that is, well, time costs money ultimately, but also the disclosure it's sort of a laborious process. It'll result in an offering memorandum that's 400 plus pages. That'll be vetted by all sets of lawyers. It'll be vetted by accountants, and all the information goes into it has to be backed up at some stage. So being able to eliminate that work stream, and a lot of these transactions being done without private placement memorandums as well, is going to cut down on the time and the expense. A benefit is also that because you're moving faster and because you can speak to investors early in the process, there is less pricing risk and also less just execution risk in terms of commodities prices moving, in terms of interest rates moving. It just reduces, it doesn't eliminate, but it reduces that risk. The one key downside really in that market is you're going to reach a more limited investor base, heavily focused on insurance companies. So we've seen an inflection point around maybe $500 million in offering size, where below you're most likely to see in 482. Above that, you're more likely to see a 144A deal. Also, the larger the deal, the more the transaction cost, the incremental transaction costs amortize themselves, and that just means you can sustain large transactions. You'll reach different investors. PE hedge fund investors tend to really more look at the 144A deals rather than 482 deals. So if you want a large deal, or if we keep seeing more and more of these deals and maybe the 482 market becomes saturated, we'll see more activity in the 144A.
That's right. And I think it's, the terms in the ones that have been done on the 144A, they've placed both a tranche of notes at the 144A offering through the offering memorandum that's broadly marketed, whereas and a tranche of 482 to more private investors and groups. The terms of the notes are largely, if there's a foreclosure or default, they're treated pari passu and getting paid off pro rata. But absent a foreclosure, the 144A has slightly better terms in a couple of respects, and that's resulted in a slightly lower interest rate. And so on these larger transactions, it's been, used both to reach a broader audience of investors so that you can get better pricing, and two, to give you a blended lower interest rate on the deals that people have gone out to. So this will be one of those issues up very early on. We talk with the investment bank and with the company and sort of figure out what strategy they're going to employ based on the size of the market and who they think they need to reach out to ultimately place these notes. But on the other side of it, ultimately, it's all big qualified institutional investors that you're placing the notes with. And a lot of them are insurance companies and groups. It's just, within investment groups, some may have desks and funds that only invest in 144A products, and some tend to invest in the 148A product where they know they're going to buy it and hold it for longer. And whereas the 144A, they may find it easier to resell or trade out of the securities and in place. So we're getting very close to the end, and we're not going to get into these necessarily key issues and considerations other than just to flag a couple of thoughts. I mean, hopefully through this presentation, what we've been able to do is give you a flavor for the deals and why they're being done. But there's a lot within the documents we talked about of issues that really pop up, like in the asset conveyance, what does it really mean to do a wellbore assignment? What consents do I have? What contracts are moving over? If I'm conveying a partial interest and retaining an interest, how do I work through that? How do I work with my midstream and marketing? All of those are sort of issues that we really try to address up front and understand and work through the agreement and come up with a sensical solution to convey the assets and to make sure that however we need to convey the assets, it's not going to create, it's going to give the issuer a functional framework where they can still operate as an ongoing business without having to go out to investors to get consents all the time to do things and run the business that they want, but give the investors the protection they need to make sure they're going to get paid and get the cash flow that they need. So we work through those types of issues. We work with the waterfall and the account structure. There's an arm's length structuring that goes into the opinions and regulatory regimes, and we'll help and work through sort of all of those. But hopefully through this, we've given everybody a chance to really understand sort of why these deals are done at a high level of what they look like. If anyone is interested in learning more about them, feel free to reach out to anyone on this panel. We'd be happy to visit further and talk about these and help people understand them. And also, if you've got assets, sort of, are they the right mix? We're also happy there's a number of different banks that are out working on these transactions that are all great, and we're happy to give you names and people to reach out to and talk to if helpful at those investment banks where you could talk to them and get their views on your assets and what the pricing may look like and what some of the economic terms if this is a product that's suitable and something that might interest your company. With that, we thank everyone for the time today and very much appreciate you listening to our presentation.